New numbers out this morning show major job growth nationwide as COVID cases fall and states roll back restrictions. U.S. employers added 678,000 jobs in February, and the unemployment rate fell from 4% to 3.8%. Here to break down what this all means is Barclays chief U.S. economist, Michael Gapen. Michael, great to see you. Happy Friday. So we were talking about this earlier with our White House correspondent, Ed O'Keefe. The numbers look great on the labor market, but wages are not keeping up with inflation. What's your takeaway?
I think first of all, thank you for having me on. Happy Friday to you as well. I think some of the weakness in average hourly earnings numbers is probably compositional. As you said, we had very strong employment on the month with revisions to the prior 2 months of data, adding somewhere between 700 and 800,000 jobs. Most of those came in services. Now, services earnings tend to be lower than, say, manufacturing and construction. So if you bring a whole lot of service workers back, as you mentioned, because maybe Omicron risks are fading and we're getting reemployment effects, then it might temporarily suppress average hourly earnings numbers. What we as economists tend to look at is what we'll call the payroll proxy. How many people got employed times how many hours did they work times what are they getting in terms of wages. That number is up over 8% so far this quarter on an annualized basis. So labor market income is still very strong, even though in this particular report, average hourly earnings on the month were flat.
Can we talk a little bit about wages? I feel like 6 months ago, the big headline was, oh, wages are at a record high because it's really difficult to get people to come back to work. But then that was all sort of eaten up by inflation. Are wages still on the way up, and are they being outpaced by inflation?
I think wages are still on the way up. Yes, labor markets are certainly tight, but I do think you can look at the contours of the last few employment reports and see some good news here in terms of a return to the workforce. The participation rate is up 0.4. So the number of workers returning to the workforce is increasing, probably a sign that the pandemic is becoming more endemic. So it's unlocking labor supply the more that the pandemic recedes. That's actually good news in terms of tightness in labor markets and future earnings growth. But for now, I still think labor markets are tight and earnings growth is solid. In general, yes, we expect it to keep up with inflation. Most of us think inflation will moderate over the course of this year and into next year. But obviously right now we're seeing a surge in inflation, partly fueled by oil prices. So at the moment, it's not as great of a story, but in general, we think employment and average hourly earnings will keep up, if not outpace inflation going forward.
So, Michael, let's talk about oil and gas prices for Americans and Europeans to an extent as well. Sure. There's been a recent jump in gas prices. That actually occurred before Russia invaded Ukraine, but we've seen those prices continue to rise. Game this out for me. If the United States and her allies decided to block, for example, Russian oil imports into the United States, I've seen some Ukrainian lawmakers saying, look, if you've got to pay an extra 50 cents or an extra $1 at the gas pump to protect Ukrainian lives, are Americans willing to sacrifice that? What is the best case scenario if the United States decided to block oil imports from Russia to the U.S.? And what's the worst case scenario for us?
Well, I think the best case scenario is to remember that as a country, we are in a much different position from an energy production perspective than we've been in many decades. We actually are small net exporters of energy. When I was a young boy growing up, we had major deficits in imports in oil. So I think the good news will be higher oil prices will likely induce some supply here domestically in the shale parts of the country. So we are much more energy independent than we used to be, and shocks to oil prices affect us less. So I'd say the potential good news here is we could get a rebound in domestic energy supply. I think our imports from Russia are only about 2 to 3% of our total imports. So we could have domestic supply that rebounds to replace it. I think the potential bad news here, the worst case scenario, is that, as you mentioned, it's what we would call an inelastic purchase for households. Households have to drive to get to work and get to places. So it's money they have to spend. And historically, it's not so much the level of oil, but the speed at which it moves. And obviously what we've seen is a very fast move, a rapid move higher in oil, which could pass through to energy. Historically, that means consumers get worried and cut back expenditures, particularly durables like autos. So I think the potential bad case scenario is households just retrench and pause and say, wait, I don't know what to do here. We're just going to hold expenditures back. The good news is we're much more energy independent, and we could get domestic supply to help offset embargoes elsewhere.
Michael Gapen, that was a very thorough answer.
Yeah, love that.
Michael,
Yeah.
thank you very much.